What's up guys, welcome to Millennials with Money, the channel that helps you take control of your finances and create a bright financial future. I'm Johnny, and if you like today's video, please hit the like button, click subscribe with the notification bell, and tell another millennial. Now, with everything that's going on in the world today, and given how the stock markets have reacted, a lot of people are starting to get interested in investing their money into stocks, shares, and funds. And rightly so, it's a great time to take advantage of it. And today's video is aimed primarily at two groups of people. Now, the first group of people, you want to get started, but you don't know where to start. You don't know what you need to know before you get started. And you're on the side of the pool, but you're hesitant to jump in. The second group of people is those of you that ran straight at that swimming pool and jumped straight in. You may have no prior investment knowledge, but you decide it's a good idea to just throw your money at a stock and hope that it goes up. If that's you, you might as well just go to the casino and put your money on black. It's exactly the same thing. There's a lot more to invest in than just hoping that a stock goes up over time. Now, I'm not going to oversimplify investing in this video, and I'm not going to overcomplicate it either. I'm simply going to give you 5 questions that you need to ask yourself, and these questions will hopefully point you in the right direction to help you get started with your research and find the knowledge and education that you need to get started. So let's get into the video. The first question you need to ask yourself is, what are you trying to achieve by investing? You need to have a clear strategy behind your investing, and your strategy should be informed by financial goals that you've set. Now, I'd strongly recommend, if you've not seen my video on setting financial goals, that you go and watch that so that you know how to make the best financial goals. And I'll leave the link just down there below for you so you can watch that. Once you have a strategy in place, it allows you to have criteria to select investments and to reject potential investments based on the potential risk that you might take on, the return that you can expect, and other characteristics of that investment. For example, if you want to generate regular passive income, then perhaps you want to invest in companies that pay a regular dividend. However, if you have a long investment horizon and you want to build your capital over time, then perhaps you want to consider smaller companies that have big growth potential over the long term. And if research in individual companies is too time consuming, or you don't have the knowledge to understand a company properly, then perhaps you just want to invest in a fund that's ready-made with a range of companies that's nicely diversified for you to save time and trust your money with someone else. If you stick around till later on in this video, I'm going to go through each one of these in a little bit more detail and explain to you what they are. The second question you need to ask yourself is, do you understand how the stock market works? Honestly, this point could be a video of its own. There is a lot of content that could be covered, but I'm simply going to use this point to debunk a common myth, a common misconception that there are amongst investors. A lot of people think that the economy and the stock market are the same thing. Wrong. They are not the same thing. When we talk about the economy, we're typically talking about the productivity of a country or a region or the world itself. And we use indicators such as gross domestic product, GDP, inflation, and unemployment to measure that over a period of time. In the current context that we're in, we'd seen years of strong economic productivity and growth up until March this year, when government restrictions and lockdowns brought economic productivity to a halt. The stock market is based on the perceived value of companies that are listed on the world stock indices, or in the singular form, stock index. And the stock market is typically measured by using the adjusted value of companies in a calculation to determine the overall direction of the market and indices. And typically it's most commonly measured by percentage point changes. This is the most common indicator that you see when talking about the movements of the stock market. If we look at the S&P 500 index, which looks at the top 500 companies in the US, you'll see that the index reached a peak in February before declining very sharply to the end of March due to, again, the restrictions, lockdowns in countries across the world, and in this case specifically in the US. And this resulted in a 30% drop in the index. Now, as you've seen so far, that certain factors can have an impact on both the economy and the stock market. And yes, there is some overlap between the two, but now I'm going to demonstrate to you how they are different. As we're all pretty aware, the current state of the economy is pretty bad due to the damage that's been inflicted upon companies' abilities to do business and the unemployment rise that's been created as a result of lockdowns and government restrictions across the world. Now, a lot of businesses have been severely impacted by this, with the worst hit being companies in the airline industry, in the hotel sector and restaurants, as they were effectively closed off and lost a great deal of business. Because the valuation of a company is very much based on its ability to generate long-term cash flows and revenue growth, a lot of investors lost all their confidence in these sectors and decided to pull their money out. And as this accounts for a lot of the stock market, the index was brought down with it. Because we were dealing with such an unknown situation back in March, companies such as Amazon, Netflix and Zoom also took a hit as panic selling spread across the board. No company was really safe. However, during the lockdowns, what happens is that a lot of people turn to these digitalized companies for their needs. A lot of people ordered their parcels, their shopping from Amazon. A lot of people spent their evenings or their days even watching Netflix at home. A lot of companies needed to continue doing virtual meetings. So what did? They downloaded Zoom. Even a lot of people at home making Zoom calls to see their friends and their family because they couldn't go see them in person. And as many companies in the airline sector, the hotel sector and restaurant sector struggled, the Amazons, the Zooms, the Netflixes capitalized on an opportunity by their ability to do business digitally and saw their revenues increase and their share prices as well, which drove the market back further up. And that is an example of how the stock market can be doing well, even though the economy is looking bad, when these digital companies are able to drive it up through their ability to do business digitally. And a lot of other companies have also adapted their ways of working to do things more digitally and to be able to work around the current restrictions in place, which has also helped to drive the market up. So in short, the economy is all about productivity, the stock market is all about company valuation, and although the two are interrelated and some factors affect both of them, they are not the same. Once you understand how the stock market works, you can move on to the next point, which is how do different types of investment work. So I'm going to outline to you 3 different types of investment that a lot of experienced investors use and that are also a good place to start as a new investor. Now, the first is investing in individual companies. Now, this is where you have a part ownership of the company by buying what are called shares. And the number of shares you have represents how much ownership you have in that company. And you can buy shares on the stock market at a particular price that is quoted on the day that you buy it. One way to make money from investing in individual companies is to sell those shares at a higher price than what you bought it for. But be careful, because that share price can also go down and you can lose money if you sell it at a lower price than you bought it for. Another way to make money through investing in individual companies is by investing in companies that offer a dividend. Now, this can come in the form of a cash payment, or it can come in the form of additional shares in that company. The types of companies you decide to invest in should be dictated by your strategy, as I said at the start. For example, if you're willing to take a bit more risk with your money and you're trying to grow it over the long term, then you might want to take a chance on a small company with a lot of potential for growth. Such was the case with Amazon in its early days, and investors that have held onto its stock until today have made astronomical returns. However, if you're looking for something a little bit more stable that maybe generates a regular cash flow, then you might want to go for a well-established company that pays a regular dividend. An example of this within Europe is the French oil company Total, which is one of the biggest oil companies in the world, and pays a quarterly dividend that it has paid without interruption for many, many years. Investing in individual companies, however, can be quite time consuming and can require a lot of knowledge so that you can really understand the business and understand what the company does. If that's too time consuming for you, or you don't have that knowledge, then maybe a better option for you is one of the following options. You could invest in what are called mutual funds, which is essentially a basket of different companies and your money is spread out across them. You can invest in these funds through your broker or through your bank, and a lot of the funds that they offer are based on your risk profile and the return that you'd like to achieve. And you can also find funds that focus on a particular niche of the market. For example, companies that pay very high dividend yields, or companies that are maybe focused on clean energy. for example. Alternatively, there is a very similar type of investment called an exchange traded fund or an ETF. Though very similar in some ways, there are a few differences with ETFs compared to mutual funds. One is that ETFs are actually quoted on the stock markets and trade at a price as if it was an individual company. The management fees are also generally a little bit cheaper for ETFs, and whereas mutual funds actually try to beat market returns, the ETFs generally tend to replicate them. So you can find a lot of ETFs that come in the form of an S&P 500 ETF, for example, a FTSE 100 ETF, a Euro Stocks ETF, something that represents an existing market index and tries to replicate its performance. Now, some of the best names out there for both ETFs and mutual funds are Amundi, BlackRock, and Vanguard. In a lot of financial news sources, you'll see that funds by these three are typically ranked among some of the highest performing funds, and they're also the top rated funds. Another way to invest in funds is via a robo-investor. Now, this follows a similar model to a mutual fund, but instead of having a person who's managing that portfolio, it's managed by a computer and an algorithm. Similarly, you can set up a monthly recurring amount and you'll continue to contribute, and the computer will manage the allocation of your portfolio, often based on your risk profile again. But as a lot of robo-investors are already using some of these big name funds in their different portfolios, they'll often charge you a little markup on their services, and for that reason it can sometimes work out to be a little bit more expensive than going through a mutual fund or an ETF. And as a beginner, if you hear someone trying to sell you on CFDs, on Bitcoin, on commodities, on options trading, don't listen to them. It's very complex, very high risk. It's not for beginner investors. Do not get involved. The fourth point that I'm going to touch on relates to news sources. And the question you need to ask yourself is, where is your news source coming from? Now, there's a lot of business and finance news sources out there, which are great places to get information from. However, the key thing to keep in mind is to think critically about the information you receive. Does it contain bias? Is it reliable? And focus on the facts. For example, if your friend tells you to invest your life savings in Tesla because it seems like a good idea, don't do it. It's not a good idea. You gotta understand why this person is saying that, whether they're just jumping on the hype, whether there's any foundation or source to what they're saying, and what their own investment goals are themselves. They may not be the same as yours. Now, in terms of business and finance news, there are actually a lot of good quality news sources in Europe. Here are a few of them just so you can get an idea of what is available in what language. Though these sources often contain reliable, factual information, they often exaggerate the facts, and they're not speaking from a long-term perspective. They're very much focused on what's going on right now at this given moment in time. As a long-term investor, you need to be very careful as to what news you take notice of. A lot of the news that you see and read on a daily basis is not applicable when considering the long-term returns of your investment. So you need to be very careful when using news sources as a source of information to make decisions from. When you're investing in individual companies, it's very logical to go and check out the website of that company. It's a great way to see their financials that they're legally obliged to disclose as a publicly listed company, and they will also share on their website a little bit about their operating model, their strategy, and their long-term goals, which are all things that you want to know about a company that you're going to invest in. However, as a potential investor in their company, they are trying to entice you to invest in their company, and they're trying to sell it to you. Therefore, they may paint a happier, more positive picture than is actually reality. So be very careful, and again, think critically when looking at company websites. Finally, some of my favorite sources are actually financial databases, my favorite two being Morningstar and Yahoo Finance. They're great places that contain a whole range of financial reports on companies. These reports follow a standard format, so it makes it very easy to compare one company with another. And there's also some opinions and analyst commentaries in there as well. However, 2 points to take notice of here is that 1, you should not invest solely on the financials. You need to understand the business activities that go on to produce those numbers. And number 2, any commentaries and opinions are just that, opinions. It doesn't necessarily represent what will happen in real life. Your own opinion is what counts in the end, and you should not let someone else's opinion be the reason why you invest in the company. And the final question you need to ask yourself is, are you in it for the long term? Now, when I started with investing, I thought that investors were all these big dogs that sat in their offices in Canary Wharf in the city of London, making hundreds of trades a day and finishing the day with £10,000 in profit. Wrong! That's not investing. Investing is not a get-rich-quick scheme, and if you think that's the reason why you're doing it, then you may be in it for the wrong reasons. Investing is a long-term game played over many years, which requires patience, understanding, and nerve to be able to come out as a winner. Ask yourself this: if the market suddenly goes down 20% overnight, are you going to hold on to your positions or are you going to sell them off? Is investing going to keep you awake at night because you're nervous about what might happen with your money? Has it got you so nervous that you're checking your portfolio every minute of every day to see which stocks have gone up and which have gone down? Investing shouldn't be like this. Investing should be putting your money in a company or in a fund that you trust. You leave it there and you let it go to work for you. You check on it from time to time, but you don't need to check on it every day. Warren Buffett is hailed as one of the greatest investors of all time, and he consistently delivers market-beating returns. His investment philosophy is unmatched, and I'm going to leave for you a few quotes from the man himself to get you thinking about the game of investing. So to summarize what I've covered in this video, you need to understand why you're investing. You need to have a clear strategy that's backed up by financial goals. You need to understand that the stock market and the economy aren't the same thing. That even though there's some overlap and that common factors can affect both of them, that they're both different. You need to understand different types of investments: stocks, funds, ETFs. You need to have reliable news sources and reliable information that you can count on, where you focus solely on the facts. And finally, you need to be committed to the game of investing for the long term. That's all from today's video. I hope you enjoyed it. Be sure to check out the Millennials with Money internet and social media pages. I'll see you on the next video. Let's get this money.